Stocks in focus next week. Reading the headlines in the Indian markets. Equity markets rarely move because of individual stocks. They move because of pressure, liquidity, and narratives that justify capital movement after decisions are already made. The past week in Indian equities was a textbook example of this reality. While headlines highlighted operational updates, order wins, regulatory actions, and interest rate changes, the deeper story lay elsewhere. In currency stress, foreign capital behavior, and the slow grind of macroeconomic adjustments, the Indian equity benchmark ended the week marginally lower after intense volatility. The Sensex declined by over 400 points while the Nifty slipped below psych, key physiological levels before recovering in the final sessions. On the surface, this appeared to be a week of indecision. In reality, it was a week of controlled distribution, a phase where markets do not collapse violently but gradually release excess optimism built over prior cycles. The macro environment, the real market driver. At the core of this week's volatility was the Indian rupee, which fell to a historic low against the US dollar. Currency depreciation is not just a foreign exchange story, it is a direct signal of capital stress. A weakening currency raises import costs, pressure corporate margins, fuel inflation concerns, and most importantly, discourages foreign portfolio investors from maintaining exposure. Foreign institutional investors (FII) continued to sell their shares, reinforcing a trend that persisted despite periodic rallies. Domestic institutional investor (DII) stepped in to absorb part of this selling pressure, preventing sharper declines. This tug-of-war between foreign outflows and domestic absorption is characterized of late cycle market behavior, where the system remains functional but fragile. Global cues added complexity. The US Federal Reserve 25 basis points rate cut provide temporary relief, but it didn't signal a decisive shift towards easy money. Markets understood this correctly. The rate cut showed the bleeding, but it didn't reverse the underlying trend. Optimism around the India-US trade discussion offered additional narrative support, yet narratives do not override balance sheet realities. In this environment, individual stock news becomes secondary. It matters for attention, not for direction. Stocks in focus. Why these names attract attention? Against this backdrop, a set of stocks emerged as inflows for the coming week. These names were not just chosen because they are destined to outperform, because they offer hooks, operational updates, policy signals, or regulatory developments that traders and institutions can react to. Interglobal Aviation (IndiGo) stability as a signal. Interglobal Aviation, which operates IndiGo, announced that it would operate over 2,050 flights per day for the second consecutive day, marking a return to operational stability after scheduling disruptions. The airline emphasized restored on-time performance and full connectivity across 138 destinations. This development is best understood as damage control, not expansion. Airlines operate on thin margins and are highly sensitive to fuel cost and currency movements. While operational normalization reassures investors that disruptions are contained, it doesn't automatically translate into margin expansion, especially in a weak rupee environment. The market response, therefore, is likely to be short-term and sentiment-driven. Bharat Electronics (BEL) defends as structural power. Bharat Electronics announced a fresh order worth 776 crore, reinforcing its position within India's defense ecosystem. Unlike many other sectors, defense spending enjoys policy insulation. Orders are long cycle, government backed, and largely immune to short term demand shocks. BEL's relevance lies not in a single order but in cumulative order book and strategic alignment with national priorities. In uncertain macro environments, institutional capital gravitates towards large sectors because they offer revenue visibility and political backing. This makes BEL a structurally significant name rather than a speculative play. KEC International Infrastructure and Execution Risk. KEC International disclosed new orders worth of 1,150 crore across its transmission, disruption, and civil verticals. Infrastructure spending remains one of the Indian government's preferred tools for sustaining growth and employment, making companies like KEC central to the capex narrative. However, infrastructure is as much as about execution as it is about order cost inflow. Cost overrun, project delays, and working capital stress are persistent risks. Markets typically reward such stocks when the order momentum is accompanied by credible execution metrics. Without that, enthusiasm remains measured. Wipro, strategy over earnings. Wipro expanded its collaboration with Google Cloud by adopting Gemini Enterprise across its international operations, using client zero approach to test AI solutions before offered them to customers. This move positions Wipro within the AI services narrative that currently dominates global IT discussions. Yet, AI adoption is not just an immediate earnings catalyst, it is a positioning strategy, a signal to clients and investors that the company is not being left behind technologically. In a weak demand environment for IT services, such announcements support valuation narratives but do not fundamentally alter near term revenue trajectories. State Bank of India systematic stabilizer. State Bank of India reduced its lending rate by 25 basis points to 7.90, lowering borrowing costs for customers. As India's largest lender, SBI plays a systematic role. Rate cuts support credit growth and help transmit monetary policy into the real economy. However, rate reductions also compress net interest margins, at least in the short term. The market views SBI less as an alpha generator more than a shock absorber. A bank that stabilizes the financial system during periods of stress. Its movements only reflect macro policy rather than pure business performance. Dr. Reddy Laboratories Regulatory overhang. Dr. Reddy's Laboratories disclosed that the USFDA issued a Form 483 with five observations following an inspection of its Srikakulam facility. In the pharmaceutical sector, trajectory actions can disproportionate weight because access to the US market is critical. Such observations do not imply immediate sanctions, but they do introduce uncertainty. Markets tend to assign a risk premium with clarity emerges until clarity emerges. This makes pharma stocks highly binary due to regulatory events. Either sentiment recovers quickly or pressure persists longer than expected. Other developments, corporate action and small orders. Companies like the Indian Oil Corporation moved into focus due to corporate actions such as X dates, while similar players like United Drilling Tools announced export orders. These events influence short-term liquidity and trading volumes but rarely affect long-term valuation unless they signal broader trend. Investor sentiment cautious, not panicked. Market experts noted that the sentiment remained cautious throughout the week, deteriorating as sell pressure intensified before stabilizing towards the end. The persistence of FII selling was a key drag, while consistent DII buying prevented deeper losses. This pattern suggested a market searching for equilibrium rather than bracing for collapse. The broader message is clear: macro forces dominate micro stories. Currency movements, global interest rate expectations, and the capital flow shape the environment in which stock specific news is interpreted. Conclusion: attention isn't opportunity. The list of stocks in focus for the coming week reflects where attention is likely to concentrate, not where capital will necessarily compound. Defense and infrastructure often offer structural support. Banks act as a stabilizer. IT pursues strategic repositioning, and pharma navigates regulatory risk. Aviation showcases operational resilience without escaping structural constraints. For serious market participants, the lesson is simple. Headlines provide entry points for analysis, not conclusions. In a period of macro stress, survival and positioning matter more than excitement. Markets reward those who understand why capital moves, not to those who merely track where it looks next. In the current phase, patience, structure, and macro awareness outweigh the temptation to chase weekly narratives.